Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I think we're about ready to get started here. So, pretty interesting market. Has been for quite some time, but this last leg down, which began in well mid September, maybe a little before that, has certainly been interesting. And so, see what we can figure out. Just a little background on our company. I started out as a derivatives research firm back in about 31 years ago. And we were selling data analysis, newsletters, that sort of thing. Then we moved into money management in 2008 after we'd had some very successful trades and recommendations during that time period during the financial crisis. So we're a money manager both in futures and on the the regular SEC side of things, being SPY mostly. Then we also have a certain amount of option education things we do. We have a mentoring program, and we do webinars such as this. I'm going to come back to this later, but I just want to mention that we will be sending you the PDF of this webinar or giving you an online link to download it. And we are going to be offering a deep discount on a couple of our products, one being the home study course and the other being some of our newsletters. So they'll be available at this URL that's at the bottom of the page here. I'll come back to that later. So when we're talking about the market, there's four main indicators that I look at. One, first and foremost, of course, is the chart of the S&P 500 because that is the market. And so if your indicators are all saying buy and the market's going down, perhaps it's your indicators that are wrong, not the market, because the market is never wrong. Price is king. So we have to pay attention to what prices are saying. Secondly, though, in the option side of things, we have a nice set of contrary indicators in the equity-only put-call ratios. Then we also look at market breadth. We have an option twist on that. And then we look at volatility, VIX, the VIX derivatives, and other things having to do with VIX. So there's a very important role, which is certainly in play right now and has been for the last couple of weeks, and that is oversold does not mean buy. I mean, we have a lot of oversold indicators right now, but very few actual buy signals. We're very specific about what our buy signals are. And just because the market is oversold, that is not a buy signal. In fact, the market can go down a lot while it's oversold. Conversely, and this is not the case now, but it was really back in August, overbought does not mean sell. So you get an overbought market, it can continue to go up until you get confirmed sell signals. But the rule we're most important to us now is that oversold does not mean buy. And of course, I'll be pointing out several situations that fit that bill as we go along. So let's start out by looking at the long-term SPX chart, the 2-year chart here. And you can see that now that we're making new lows, and we made even lower lows today, we've fallen 24.7% from the high. Back in 2020, we in the pandemic crash, or whatever that was, we fell 35%. But since then, we've had just minor corrections. There was a 10% correction in September 2020. Then all of 2021 basically had no corrections, a little tiny 6% correction. And it seemed that earlier this year, that as the market broke out to the upside, that everything was going to be wonderful. We were going to be going for new highs. However, we did have a number of warning indicators, some of which I'll show you, and the market quickly fell apart. So now we're in a severe downtrend. This is a bear market, and forget the fact that we're down more than 20%. That's not what makes it a bear market. What makes it a bear market is the series of lower highs and lower lows that are determined by those blue trend lines on the chart. And now that we made new lows, we have all these oversold conditions, I'm seeing a lot of people want to buy this market. I don't know. To me, I'm not buying until I see actual confirmed buy signals. But what if we come down and we tag this bottom line again? I mean, then you're talking maybe 3,200 down here before we could actually do that. If this market is on a direct course to 3,200, there's going to be a lot of pain along the way. And this one particular website that I see where they're always talking, supposedly professionals, but they're always talking about how oversold the market is and how much they want to buy it. And I don't know. To me, the first lesson I learned was oversold is not me buy. So I am not buying this market, not right now, anyways. Here's a little bit closer chart, a 1-year chart on the S&P. Same trend lines. A couple more data points on here. First of all, you can see these oversold rallies that happen in bear markets. They're very common. They're very volatile, and they make you think that the bottom is in, but of course the bottom isn't in. And in fact, even that one that began in June, and it certainly seemed like maybe that was really the bottom, this thing here. And it got all the way up here, got right to the 200-day moving average, which is this line, and the trend line, which is the blue line, and failed perfectly right there, just like right on cue. Now, those two circles there, those are island reversals. An island reversal of that form, where it spikes up and then spikes back down again, leaving a gap on both sides of the island, is a very negative formation. You don't really see them in index charts, especially broad-based index charts. I recall one in 1974 on the Dow, which was very important. It led to a huge down leg in that bear market. And here now, these two are leading to a pretty severe down leg that we're experiencing right now. So, I really haven't heard too many people talk about those, a few, but those are certainly significant formations. So now we're down here, we're testing these lows just above 3,600. The low today was 3,610. So we dropped a little bit even farther today. This chart is through yesterday, as you can see at the top of the chart there. So we're basically making new lows as we go along here. This day is through yesterday. So today we dropped down to 3610, like right here. So another new low. So people were hoping that 36, 37 low from June might hold and be a double bottom. And I suppose if we rallied from here, you'd still be in the general area of a double bottom. It doesn't look like it's going to hold right here, though. So where would support be? I'm going to back up one slide. This longer red line spanning across the entire chart goes back to the last time we were at this level, which was in November of 2020. And at that time, a little work was done creating some support right around the 35.50 level. So I would say that's your next potential support. But if that gives way, then you're looking at levels like this. And now if that comes into play, of course, you're looking at that bottom blue trend line. Anyways, so the point here is that you have these huge oversold rallies in a bear market. Doesn't change the fact that it's still a bear market. What makes it a bear market is the downtrend in the SPX chart, not any percentages, nothing else. Now you can go long other trades in here. So basically, we've been bearish since early January. That chart has been bearish since early January. There might be support, as I said, at 35.50, which is we last visited that almost 2 years ago. The big failure this summer actually in August at the 200-day moving average as well as the trend line creates heavy resistance up there. There's also resistance at 3,800. And we know these oversold rallies come along. But our basic position is that we're maintaining a core bearish position, and we'll trade other signals around that. So one more thing on the S&P/X chart. We draw Bollinger Bands on the chart, but I do what's called modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he used the definition of volatility to be the standard deviation of closing prices. But that's not what Black-Scholes uses and other mathematicians Black-Scholes uses, in fact. The standard deviation of daily percentage price changes. Slightly different, gives you slightly different numbers, but since we're an option-oriented firm, and since we need our volatilities to agree with Black-Scholes models volatility, we use this definition. So what we do is we draw 3 and 4 standard deviation bands, modified Bollinger Bands around the S&P. 20-day moving average, just like Bollinger Bands do. And then we trade those as signals. We've had a great success with this system over the years, dating back quite a ways, but it was giving too many false signals. So we created a secondary confirmation system called McMillan Volatility Bands, MVB. So here's the current chart of the S&P 500 with these bands drawn on there. So there's your +4 standard deviation band. There's your +3 standard deviation band. So you can see here that in August, as it came up and met that trend line, it also traded above the +4 standard deviation band and then fell back below the +3 standard deviation band, and that gave us this sell signal. So this sell signal is in place until we tagged the -4 standard deviation band, and we did set up a buy signal there. That buy signal did not work. So you can see back here we had successful sell signal here, and then a successful buy signal here. It took a while to tag the upper band, but it finally did right there. Then we did not get a sell signal at that top, but we did get a buy signal here at the bottom in June, and it tagged the upper band up here. And so this is the most recent trade. That was the losing trade we bought in here, and we just got stopped out last Friday when the S&P closed below the -4 standard deviation band again. Of course, that's going to set up another buy signal, perhaps down the road. I will say, though, that just because you get a move inside the 3 standard deviation band does not necessarily mean we get the buy signal. For example, last summer, here you can see we went below the we went below the -4 standard deviation band, and then came back inside right here and closed above it. That's the old style classic buy signal. But we, as I said, we're getting whipsawed on some of those, so we created this secondary confirmation calling it the McMillan volatility band buy signal. That never came about. So the market continued on down for several hundred points, 600 or 700 points, and we were able to stand aside. So just because now on yesterday and on that big rally we had on the 28th, gave us a buy signal right here, a classic buy signal again, does not necessarily mean we're going to have a McMillan volatility being a buy signal. If so, just to review here, the last one was just stopped out for a loss, but we're perhaps setting up the next one by this classic buy signal took place. The fact that we were down, 78 points today sort of means we might not be getting McMillan volatility band buy signal, but it would occur if SPX closed above 37.37. That's nearly 100 points above where we are right now, but that's not a guarantee. So, we play the signals as they occur. We don't try to interpret them. All the work has been done in back testing and trading these over the years, and so we are not about to change any of that on a whim. If you like the idea of those bands, we have a subscription service, so we'll look at every stock, every index, every ETF, and every futures contract, and send you daily all of them that have setups for McMillan volatility band buy or sell signals. Anyways, let's move on to the next topic, which is put-call ratio. So put-call ratios were invented by Marty Zweig back in the 1950s when he was getting the put and call volume out of the ads run by the put and call broker dealers that ran in Barron's every Sunday. And he totaled up the calls that traded and the puts that traded and try to come up with some analysis. For our purposes, we use the equity-only put-call ratio, which today is all the stock options that trade. That's millions of contracts. But Marty was working with a much smaller data set. He did, however, notice that if there was a lot of put buying, pretty soon the market went up. And if there was a lot of call buying, pretty soon the market went down. So he realized this was a contrary indicator, that wrong way speculators were the ones in here doing this trading. And that's what we still try to identify today. Now there's millions of contracts traded by hedgers and arbitrageurs and institutions have nothing to do with speculation. but that's sort of just the base noise. The speculation will drive the ratios higher or lower around that base level, as you will see. So let's just look at the simple standard put-call ratio. Let's say IBM at the end of the day, we sum up volume of all the puts that traded on IBM today. Separately, we sum up the volume of all the calls that traded, divide the two, and that's the put-call ratio. Now, notice that since puts are in the numerator of that ratio, as put buying increases, the ratio will go higher. However, when is put buying likely to increase? Well, that's when the stock or underlying is going down. So the put call ratio moves opposite to the stock price. Same thing with calls. If we increase the denominator of a fraction, that makes the fraction go lower. So if call buying increases, the ratio is going to go lower. But when is call buying likely to increase or be heavy? That's when the stock is rallying. We keep a 21-day moving average just in case there's anything to Fibonacci. And we get these kind of charts. So on our website, we publish over 1,600 put-call ratio charts every day. And that's there's a data portion of our website that you can subscribe to for a fairly low price, something like $25 a month, and just look at data. One of the data sets being these put-call ratio charts. But here's how every chart should look if you're going to trade it, and that is the stock price and the put-call ratio should be moving inversely and somewhat symmetrically. So let's say the stock is falling. As the stock is falling, people are buying puts, buying puts, buying puts. Eventually, the put buying runs out of gas, and we get a local maximum on the put-call ratio chart. A local maximum on that chart is a buy signal for the stock. Then the stock should start to go up, and as the stock is going up, people are buying calls. Move to the left here. The call buying forces the ratio lower until finally it sort of exhausts itself, and we get a local minimum on the put-call ratio chart. The local minimum on the put-call ratio chart is a sell signal for stocks. So these charts should be a mirror image. If you're looking at, let's say you get interested in one of these, you look at the chart and it's not a mirror image, then something else is going on besides speculation. It could be arbitrage, could be a takeover, it could be, distortion because of earnings or something. So if the chart is not symmetric like this, you might want to think pretty hard about not trading that put-call ratio signal. This is not a current chart, but on top is the S&P 500 index. And on the bottom is the equity-only put-call ratio that we talked about, all stock options that trade on all U.S. option exchanges, which I believe there's 8 or 9 exchanges now. So you can see the inverse symmetry that exists most of the time, and that's why we use the equity-only put-call ratio to predict the stock market. So having said all that, where are we now? Well, the last significant local maximum or local minimum that we had was this local minimum right here in late August, mid to late August. That's a sell signal. Remember, the local minimum is a sell signal. And now the ratio is racing higher as the market has gone up. And of course, that's for yesterday, not today. The market dropped back to a new low. And I'm sure this ratio went higher again. So this is remaining on a sell signal. Now, the fact that it's up at those very high levels, these are the highest ratios that we've seen since March of 2020. This ratio right here is as high as we've seen since then. So it's oversold. But oversold does not mean buy. This thing is still racing higher. When we get a buy signal, it will roll over and begin to trend down, and that's going to give us the buy signal. Now, we have computer analysis programs that help us spot that rollover quickly when it occurs. But frankly, these ratios have a certain amount of reversion to the mean analysis baked into them. And so we're so far from the mean right now that, they think it's ready to revert immediately. Me, I want to see it actually roll over. Now, as computers have come along, we're able to use another, perhaps better put-call ratio, and that's the dollar-weighted put-call ratio. So what we do at the end of the day, for every option that traded, we compute its dollar volume in this fashion. We take its closing price and multiply it by the volume that traded that day. Now, I realize you could do this tick by tick. That's a pretty expensive prospect. The data is expensive, the computer power is expensive, and we found out using it this way is just as it gives you just as good as signals. So we do this at the end of the day. We calculate these dollar volumes of all the puts. We add those up separately. We calculate the dollar volume of all the calls. We add those up, divide the two, and now we've got the dollar weighted put call ratio, or just the weighted put call ratio, and we're measuring the volume of dollars being spent. I'm sorry, we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So the timing of the signals is very similar, but the extremes are more evident. So here's the current weighted put call ratio. And again, this is across all option exchanges, all stock options that trade. So the low was made back there in mid-August, just like the other one. So local minimum is a sell signal for in this case the market, and this has really been racing higher. This is clearly above the peaks of May, and is giving, is at the highest level since March of 2020. And again, because the market was down so sharply today, I'm sure this is even higher. We won't know that till we calculate everything later tonight. You can see that back last November, the ratio was quite low, and we did get a sell signal then, but that was the lowest that the ratio had been in 18 years. And so we've gone, so that's a very optimistic extreme. Now we've gone from optimistic extreme to pessimistic extreme. And well, really, we did that in about 6 months, but now, we're coming on towards 10 months and still, no relief in sight. Eventually, this will rise up and make a new local maximum, and that will give us a buy signal, but not yet. So this is one of our better indicators, and it's more of an intermediate term thing, only a few signals per year. These sell signals that we're experiencing right now have been in place since mid-August. Well, obviously, we're in oversold territory. The ratios are so high on their charts. But again, we're only going to call a buy signal if they roll over and begin to decline. Now, there's also something we look at called the total put call ratio, and it's in a very similar state as well. That's the the 21-day moving average of all index and stock options that trade. So what do we trade when we get one of these signals? Well, typically, I'm in the business of predicting what the underlying is going to do. In this case, the underlying being the S&P 500. And so I'm going to trade a SPY option. But since I'm in the business of predicting what the underlying is going to do, because it could be a stock or a futures or an ETF, I want to buy an option that's going to reflect that movement in the underlying. In other words, an option with a fairly high delta. The delta of a call ranges between 0 and 1. So if I'm doing something bullish, I want to buy an option with a delta of 0.7 or higher. That's for a short-term trade of, let's say, a month or less. If I'm looking at a little bit longer-term trade, I might buy an at-the-money option. But again, it would have a delta of 0.55, so it's going to perform, it's going to respond and perform with the underlying. The worst possible scenario for me would be to be right on the underlying, be wrong on my option, which means I bought something way out of the money that didn't perform. So on TV, if you watch, you see almost every time these guys trade, they trade a spread. Now, that's, well, first of all, wrong, the wrong thing to do. But secondly, I don't even know how that possibly got started. There is a time to use a spread, but most of the time you don't want to unless the options are expensive. So typically, if you were to buy a call at one strike and then spread it by selling a call at a higher strike, you cut off your profit potential if the underlying goes above that higher strike. And in fact, the only time you should really ever be considering this is when options are very expensive. That is when implied volatility is high on a historical basis. And we publish a complete set of implied and realized volatilities on our website for free every Saturday. And in addition, if you want them daily for a low cost, you can also get that. But if we were to buy the call, that's the red line there. You can see the call has a little more risk on the downside here because it didn't sell that option. But on the other hand, up here it's got a lot of profit potential if it goes above that price right there. Now, the proponents of the spread say, well, you're risking less. You're not risking less. You're risking 100%, whether you buy a bull spread or a call. If it goes down and all your options expire worthless, you've lost 100% of what you put up in the first place. So to say you're risking less, it means dollars, and you can control your dollar risk by, let's say, instead of buying 4 bull spreads, maybe you just buy 3 calls or something like that. But I would never spread unless options are very expensive. And even if options are expensive, let's say VIX right now is pretty high. It's not maybe high as it's been in history, but it's certainly relatively high, especially for this year. So when we're doing our SPY trades, we're typically doing a spread. But you can minimize the negative effects of the spread by, first of all, uh, increasing the distance between the two strikes and then rolling into position if the short strike is hit. So, for example, right now, if we're buying call, if we have a bullish signal in VIX, we would put a spread 13 to 15 points between the strikes. If we have a bearish signal in, I said VIX, I meant SPY. If we have a bearish signal in SPY, then we want to have 25 to 40 points between the strikes of our SPY put bear spread. And what do I mean by roll if the short strike is hit? Well, let's say S&P or SPY is 397 and we buy this bull spread. We buy the 397 and we sell the 412. And we're fortunate enough to see then SPY goes up to 412. But now we've hit our upper strike, we've hit the short strike. So sell the spread you owned, take a profit, and instead establish a new spread up here, buying the 412, long the 412 and short the 427. And that would give you, not only have you taken a partial profit, put some credit in your pocket, but now you've opened up the upside and you can then make even more on the way up. I want to just show you a couple of individual put call ratio charts here that we've been looking at. This is Bristol Myers, and you can see that on these charts with where we're talking about stock or futures options, I only use the extreme signals, the ones way at the edge of the chart. I don't use the wiggles in the middle of the chart. They've proven to be too flighty. So I'm not using those local maximum or minimum, but I am using the ones way near the bottom of the chart, way near the top of the chart. So a blue signal, a blue letter means that wasn't a great signal. I mean, if we bought here, it went down, so that wasn't that good. But the next one was good. And now we're getting a new buy signal here. So what we typically do is look at the chart, and if there is a resistance area, as there is here, just above 72 on Bristol Myers, we want to see that thing break out over 72 before we actually act on this signal. And the stock was down a little bit today, but it's still closed around 71.70. So if it breaks out over 72 there, this buy signal would be in effect, and we would buy some calls. Here's another one, Pfizer, has a decent history there of buy signals. Note that at the time when the buy signal occurred a year or so ago in November, this seemed very high on the chart. But now, since then, we've gone even higher and now even higher. So the next time we get a local maximum at that level, over here, that would not be a buy signal. But this one is, so we formed a buy signal, and now we're just waiting to see if it can break this trend line that it's in, this downtrend. Similarly with PVH, what's crazy here is the put call ratio. This is weighted 700. Means $700 are being spent on puts for every $100 being spent on calls. That's insanely bearish. So people are really, really bearish on this stock, or at least the option traders are. And so we're getting a buy signal now from a local maximum at a very high level on the put-call ratio chart, but we do need to see this stock show some signs of life and break that downtrend line before I would jump in on it. We can also trade futures. This is not a current chart, but corn. The bottom blue put-call ratio chart is the puts and calls volume, weighted volume, from the corn options that trade on the Chicago Board of Trade. But so you can use that to determine your signals, and you can see there was a nice buy signal there at the end of July. But you don't necessarily have to trade corn options on the Chicago Board of Trade. In this case, there is an ETF called Corn, CORN, and in fact, many of the futures contracts have an ETF, like gold has GLD, silver has SLV, bonds have TBT, etc. Anyway, so sometimes we have signals based on these futures options, but we don't necessarily trade the futures. We might trade these ETFs. So moving on to the next subject is market breadth. And breadth is simply the daily number of advances minus declines. You can keep a cumulative total, or you can keep an oscillator. So we're big on the oscillator, and the way we look at it, today's oscillator value is equal to 90% of yesterday's oscillator value plus 10% of the difference today, advances minus declines. And there are a couple nuances to this. First of all, we can just use New York Stock Exchange data. That's the most common form of getting advances and declines. But the problem is on the New York Stock Exchange, there's some things that aren't stocks. And so we looked for a more pure stocks only sort of data set. And it turns out that we clearly had one right under our nose. That's all stocks that trade listed options. And we're looking at those every day. So that is our set of stocks only. We keep this oscillator. This is the oscillator going back to 2013, so 9 years. And for most of the time since 2013, the market was bullish. So it really didn't get oversold very often. We had a couple of pretty severe oversold conditions. This was 2018, right before Christmas. Of course, this was March of 2020. Both very severe oversold conditions. And by the way, again, oversold does not mean buy. So we don't buy until they stop being oversold. And then you can see at that point, they got very overbought up here, went extremely high and got very overbought. But we were not hitting the exact bottom. In fact, we don't ever really hit the exact bottom on anything. That's not the way I think is the proper way to trade. The proper way to trade is give yourself a confirmed buy signal, which might occur a little bit after the bottom, and then it's a strong one going forward. Now, in the last couple of years, you can see a lot more oversold conditions. And in fact, just this week, we got the most oversold reading in history. So more oversold than these two back here were. That's a little surprising, but that's the truth. And there are more stocks with listed options now, which does contribute to that to a certain extent. Anyway, we launched this sell signal here. Breadth went from slightly overbought to back into neutral territory, gave us a sell signal on September 13th. That sell signal is still in effect. The breadth again today was a disaster. New York Stock Exchange more than 2,000 more declines than advances. Stocks only is probably going to be closer to 4,000, and breadth is just a mess right now. So you're on sell signals. You're in deeply oversold territory, but still on sell signals. In fact, you are so oversold, it's going to take several days of positive breadth just to dig yourself out of this hole and get back, up to here where we give the buy signal. So this is nowhere near a buy signal. This is typically one of our most sensitive indicators that flips back and forth. Right now, it's not going to be flipping back anytime quickly, but it's been a good indicator this year. And, it's a good indicator all the time, but this year it's been especially good. So I just want to mention cumulative breadth. I said one of the things you can do is accumulate the breadth figures daily. So that is useful in spotting market tops. And in fact, it was useful last year. So in June 11th of 2021, both the S&P 500 and cumulative breadth made new highs. But then going forward for the rest of the year, the S&P 500 made new highs something like 30 times, all the way up through January 8th of 2022. Meanwhile, cumulative breadth fell back and did not make any more new highs for the rest of the year. So you basically ended up with a 7-month divergence where S&P was making new highs, but breadth was not. That's typically the forerunner to a bear market, and of course it was a forerunner to this bear market. But right now, that's just something to store away. The next time S&P is making new all-time highs, you'll start paying attention to that indicator again. Right now, it's meaningless because we're not near an all-time high. So another thing we follow is new highs versus new lows. New highs just can't get off the mat. They are extremely low, and their sell signal was given last April, and it's still in effect. So I hear people say, making excuses like, "Oh, well, new lows aren't as bad as they were 2 weeks ago." That is not the thing you need to be looking at. The thing you need to be looking at is new highs. New highs in the New York Stock Exchange. Until those can get into triple digits, this is still going to be a bear market. And they're really woeful right now. They're running, 8, 11, 12, 13 numbers like that each day. I don't know officially what the number is today, but the one thing that I use as an estimate, let's see if I can even find it on here, seven new highs today. So not very good. Anyway, moving on to the final set of indicators that we look at, which is VIX. So VIX is the CBOE's volatility index. It's very useful in a number of ways, one of which is the trend of VIX. VIX should be trending opposite to the market. And we have a very specific definition as to what is the trend of VIX. And then in addition, VIX will occasionally spike up and spike back down again. Typically, that's a panic in the market that goes away, and it's a contrary buy signal. I will say that this year, VIX has certainly not been nearly as high as you might have thought it would be when the stock market is down 25% in, 10 months, almost, 9 months, I guess. So that's somewhat irrelevant. It is what it is. You can't change that. You can't sit around and bemoan the fact that, VIX is not doing what it used to do. So, as an aside, a low VIX is overbought, but again, we haven't had a low VIX since 2019, so since before COVID. So here's the current VIX chart, and you can see all the spike peaks on there. So all of those Bs are trades that we made. Now, when there's two shades of a B, like here, there's red and then orange, we only trade the first one, the red one. There's like dark blue, light blue. So the signals here are just as they were on the other charts. Red letters are successful trades, blue letters are not. And in a bull market, VIX is going to just rip off a whole series of these buy signals. Will be all profits, very few non-profitable situations. But now we're in a bear market, is got to work harder for this. So you can see that most recently we had a failed signal here, and then another failed signal here, and now we've just gotten a new signal as of the 28th. Already off to a bad start with today. But this will be in effect unless VIX closes above the peak there, which I believe is 34.88. So again, we have rules on these. Subscribers get told the rules. They're not super secret things or anything. But perhaps the more important thing on this chart, I'm going to see if I can get rid of some of this writing on here. So perhaps the most important thing on this chart, though, is these trend of VIX. Remember I said VIX should be trending opposite to the market. And so when both VIX and its 20-day moving average are above the 200-day moving average, so this is the 200 right here, and you can see the 20-day crossed above it right here. VIX was already above it. So that was a trend of VIX sell signal that was given right about last December 1st. That stayed in effect all the way over to here, where there was briefly both of them went below VIX. So that was the trend of VIX buy signal, which only lasted a couple of weeks, a few weeks, and now as of September 20th, we've gone back into a trend of VIX sell signal. If you look what the market's done since September 20th, it's been pretty ugly. So it was a pretty well-timed sell signal, and this is an intermediate term thing. You can see that the last sell signal lasted about 7 months, 8 months, and this one could easily do the same. Somewhere along here, VIX may explode to the upside. It hasn't yet. In past years, it would. On a decline of this large in the market, we would have seen VIX up near 50. In March of 2020, VIX got to 90. I mean, here we're talking that it hasn't even gotten to 40 yet. So that's something I can't completely explain, although I will give you my opinion on that in a minute. But so right now, we're looking at this. The trend of VIX sell signal is still in effect, and it's sort of interesting to note the market was really oversold on September 20th and was dropping, and so many people said, "Well, I'm not going to take a new sell signal because all these oversold conditions are going to give buy signals." Well, guess what? It's now 10 days later. The market's down a lot. The oversold signals conditions still have not produced many buy signals, and the one sell signal that did exist is the big winner here. So you need to stick with confirmed signals, especially if these systems are back tested like ours are. And so we took that sell signal and ignored the oversold conditions, and it turned out to be the right thing to do. So now, as I said, we just got another VIX spike peak buy signal. Yesterday, and it would be stopped out if VIX closes above 34.88. It's interesting. Today, the market was down a lot, 78 S&P points, and yet VIX was only up $1.66 at 31.84. So, it's going to have to go up more than 3 points to stop out this trade right now. Again, we're in a bull spread there, called bull spread, so it's not like we're long S&P futures or something. And one just final comment here on the VIX. Last year it was holding at 15 or so, and that was 2021 when the market was going off to new all-time highs. Typically when the market's making new all-time highs, VIX drops to 12 or even 10. That didn't happen, and that was sort of an indication that the big money is what trades SPX options, and SPX options is what determine the price of VIX. And so big money's not always smart money, but it is a lot of the time. And so big money was buying puts. They were holding VIX pretty high. This year, they've held it even higher, even when we had rallies and things. VIX has not come down below 20. So you can't trade VIX, though. That's a problem. It's a very complex index. And you can read about how it's calculated and all, but you can't really trade it. But what you can trade are VIX futures and options, and so we use them as well as their technical setup to make further market predictions. So in a bullish stock market, what you're going to see is the near-term VIX futures are at a low level. Typically trading at a slightly higher price than VIX. Say VIX might be here, and then the near-term future a little higher, and then the next month a little higher, a little higher, a little higher, and then the 3-month one is just priced at sort of average volatility because nobody knows really what volatility is going to be in 3 years. So the term structure, how the futures relate to each other, slopes upwards, and the futures are all trading at a higher price than VIX. So that's a bull market. A bear market looks just the opposite. VIX will maybe be here, and all the futures are trading at a higher price, and the term structure slopes downwards. So that's pretty bearish when that happens, and we're just now starting to see that begin to happen. So I took these prices this afternoon at 1 o'clock. VIX was trading at 32.12. The front month future, the nearest term future, was trading at 31.30, So that's a discount of 82 cents. So we take 31.30 minus the price of VIX, 32.12, and that's minus 82 cents. You can see the next futures contract, November, is trading at a lower price. And then the next one lower than that. So the term structure is starting out on a downward slope. Then it kind of just flattens out after that. So, it's not necessarily sloping downward over the entire spectrum, but even the fact that the front part is sloping downwards like that is negative for stocks. Plus, you can see they're all trading at a discount to VIX. And remember, I said, if they're trading at a premium to VIX, that's bullish. But in a bear market, they're trading at a discount. Again, a negative setup. And this is the first time we've really seen this this year. In the past, it's been much more extreme than this. I mean, in March of 2020, the premiums were minus 16 and things like that. So minus one, minus 82 cents, a little bit of a bearish thing, but not extremely bearish. Now, the CBOE publishes 5 volatility indices. VIX is, of course, the most famous one, and that's a 30-day volatility. But they do a 9-day, 3-month, a 6-month, and a 1-year. Typically, in a bull market, these would all slope upwards, but now it's kind of all jumbled. The 9-day is higher than the 30-day. The 30-day is higher than the 3-month. And let's see how they closed today. Yeah, they closed in that same relationship, not same prices. Then we got one that pops up and then back down again. So it's kind of muddled, but the front part again sloping downwards, that's modestly bearish. So we don't like to see that. And if the two front month futures deviate, if October, the front month, rises more than 1 point, 1 full point above November, the second month, then that is really quite bearish for stocks. And that has brought in some heavy selling in the past when that happens. So, things are a little more moderated this year in VIX than they have been in the past. So maybe that won't really bring in such heavy selling, but I would certainly not want to be long while this is happening. So this is a bearish phase, and we're just going to have to see how it plays out. As I pointed out, in past years, the bearishness was way worse than this. So this is just sort of a mild case of the blues or something, not exactly a real outright bearish sign from we call it the construct of VIX. So I mentioned, this year people are wondering, why is VIX not going above 40? Why is it hanging around down here? And there's probably a lot of reasons, but two of the bigger reasons is, number one, a lot of people have switched their, let's say, protective strategy away from buying SPX puts to buying VIX calls. That hasn't worked out at all well this year, but whatever. So there's a slightly lack of demand for SPX puts. Perhaps people already have them too. They bought them before, and they're only rolling them, so there's no real net buying of SPX puts. Last week when the market dropped quite a bit, there was some increase in that demand, but nothing huge. In addition, the out-of-the-money puts on VIX, SPX are quite expensive. That's what big money likes to buy for protection, and so aggressive traders are selling those out-of-the-money puts, and so you have a excess of supply, decrease in demand, and so really that's in SPX puts. But SPX puts are the main driver of the price of VIX, and so VIX is lagging. There's probably more to it than that, and we'll never really know for sure, but that's certainly a pretty decent guess. So, summarizing, we have one buy signal in place right now. That's that VIX spike beat buy signal that happened yesterday. We have one neutral situation in that we don't have a McMillan volatility band signal at all right now, but a buy signal might be setting up. Every other indicator that we have is bearish. The chart of the S&P 500, a clear downtrend, bearish. The trend of VIX, both those, the 20-day and VIX are much higher than the 200-day. The trend is up in VIX. That's bearish for stocks. Equity and put call ratios, oversold, but still haven't rolled over to a buy signal. New highs versus new lows. New highs are just, you know, in the wastebasket. So that indicator is negative. Breadth, terrible, terrible breadth. Oversold, but still not a buy signal. And then finally, the thing we just looked at, this construct of volatility derivatives is starting to slope upwards. That's modestly bearish too. So, you know, you can tell me, yeah, but the market's oversold and all these sell signals, must be time to buy. It's time to buy when we get confirmed buy signals. It's not time to buy just because there's oversold. Just because, let's say, the market made a new low, that's a time to buy. I mean, that's really catching the falling knife. And that I don't do. I'd much rather miss the actual bottom by a few days and catch a really solid uptrend than try to, you know, find a day like yesterday and then followed by a day like today. So that's, you know, getting you nowhere. Um, so our main conclusion is that we're maintaining a core bearish position, and we're going to trade individual system signals around that when they give buy signals. But they're oversold, and that does not yet mean buy. Now, I got one more chart for you here. Oh, well, this. Let me throw this in. So we will send you a link to the PDF of this webinar. Or in fact, this is the link. If you go to this website, and register with just your email address, you'll see the link to get the PDFs. Also, last year we recorded a brand new 14 webinar home study course. It's about 20 hours in length, and we're selling it for $199, which that's a really great price. I think that's $300 off the regular price. So that's also on the page. And then our 3 top newsletters, daily volume alerts, the daily strategist, and the option strategist. You can take 1 month of all 3 of them, and I believe that's for $99. Let me look at the next slide. Yeah, $99, not $199. And you can take all 3 of these. If you sign up for that, they're all going to come to you at once. You probably don't want that. So let us know if you'd like to take them consecutively, not concurrently, and you can get a better chance to evaluate each one as it's going on. The Option Strategist is our once a week newsletter. It comes out on every Friday, and it's in its 31st year of publication. There's a full track record by strategy of all 31 years on our website. The Daily Strategist is basically the same thing daily. There's a few twists, and the track record is available on our website as well. And then Daily Volume Alerts was originally started to trade high, you know, increased volume situation looking for takeovers. That hardly ever happens anymore. So it's really evolved into trading these indicators that I've just talked to you about. So here's how these system trades have done in that newsletter so far this year. And we don't risk more, probably not more than $1,200 in any of these trades, maybe $1,500 at the outside. And we're up 13,000. Rarely do we have more than 4 or 5 trades on at once. More typically, it's 2 or 3 trades on at the same time. So it's not a totally expensive service, and it's done really quite well. And in fact, the track record that's up on the website goes all the way back through 2018. These system trades have made $47,000 over that time period. So we also have a YouTube channel. I invite you to be a subscriber. I record a market comment every Monday morning. And we have a couple of other newsletters as well if you're looking for a more conservative approach, selling out of the money puts, sort of like that's covered, same thing as deeply in the money covered calls. And then we also have a special situations alert newsletter, which is not looking to speculate on the market, but just on special situations. So here's the chart I wanted to show you. So this is the 1973-74 bear market. Came into the year 1973, everything was wonderful, made a new all-time high, basically right around January 8th, just the same as we did this year. And then a bear market set in with all of these oversold rallies taking place, these things that are just driving the bears nuts, but the trend is driving the bulls nuts. Eventually, the thing makes a new low here in late August, and then sets off this monster rally right there, which pretty much wipes out all the bears. And still the bulls are at a loss. Then it turned. We had the oil embargo, and market rallied slightly into the oil embargo ending. By the way, this is that island reversal I talked about, and the Dow. This is a chart of the Dow. And then things started to fall apart. So the three I's came up: inflation, interest rates, and impeachment. Impeachment being Nixon was president. Then eventually it broke to new lows. Then Nixon resigned. The market collapsed all the way into an October bottom, which became a W bottom when it was retested in December, and the market then took off, and that was it. What was so ridiculous here, Gerald Ford was president by then, and he had this whip inflation now campaign, and he was giving out buttons, so you might still see them like memorabilia collections or something, win buttons. But it didn't end inflation. That went on well into the Reagan administration, but it did end the bear market. I can't even explain it, but it did. And so, but that was a nasty long-term bear market. So on that scale, where are we right now? It looks to me like we're about right there. We just made new lows in the summer, late fall of the first year of the bear market. We could be coming up now because of all these oversold conditions on a big strong rally that makes the bulls all feel wonderful and wipes out the bears. But I really think there's a chance we don't bottom until October of next year, just like this market did as well. Just an opinion. I'm not really putting together any 1 year positions or anything like that. But I just, you can see the trend line might have been threatened, but was really never broken. That's a long-term downtrending bear market. All right, so that's how you can contact me if you're interested in our money management stuff. You can uh, you can go to this website and fill out a little form, see some track record, et cetera, et cetera. That's our email address there. And so let's see if we have questions. How do I get these things open? Okay, is it? Do you use butterflies to pin closing prices for SPX? I traded arbitrage for a number of years. The whole pinning thing is more myth than fact. But no, I don't do that. Question: do you follow gamma levels and why or why not? Well, we pay attention to gamma in our trading that we're in our managed money. Is in these recommendations we're making here. Many of these are just strictly speculating, so gamma is not a particularly important factor when you're just long a bunch of options. And we're pretty attentive to rolling an option when it gets too far in the money. When, in other words, the delta is building up, and we don't really hold them all that often all the way to expiration either. Do you use options on 3x levered ETFs? Well, I would. I mean, we don't typically trade those. But if I saw, for example, we do sell some naked puts, or we do some option selling strategies occasionally. We have a couple of other strategies based around things that might be hard to borrow. Those kind of ETFs would be hard to borrow. But if we see expensive puts on those, we might take a shot on them. Otherwise, as far as just outright trading, that if you we're pretty much using our speculative strategy is figuring you're going to risk about 3% of your bankroll, let's say, on a trade that we might make, and that's about it. So our trades have a lot of leverage built into them. Not really looking at those things specifically. Let's see. How do you think tomorrow's quarterly expiry will affect the close or next week? Okay, so the quarterly expiration was last Friday. It was I see. You mean the end of the quarter. I see what you mean. Okay. The end of the quarter options are not they're traded like amongst big institutions and things, but the big open interest typically is in the third Friday, the old style, monthly option, third Friday of the month. So I'm not expecting a whole lot of important movement on based on that. Is VIX a good hedge against puts on the market? Okay, I'm not exactly sure what you mean by that, but a VIX moves opposite to the market. So you could buy puts on the stock market or calls on VIX. Either one would be a hedge. So far this year, puts on the market have been a much, much, much better hedge than calls on VIX because VIX has not really gone up. Now, having said that, I always still own some calls on VIX in case the explosion comes. But when we're really hedging our downside risk right now this year, we're using puts or put spreads on SPX and SPY, buying put spreads on SPX and SPY as our downside hedge. In 2020, VIX was a beautiful hedge. In 2008, VIX was a beautiful hedge. This year, it's not a beautiful hedge. Okay. How high could VIX go this year? I think that's what that question means. No clue. No clue. I mean, it's, VIX is, as we've seen, that most every 25% decline we've ever had in the market, VIX would already be way higher than it is. So there's other factors that work on VIX right now. And I hear people tell me, oh, yeah, it's matured as a product and the open interest and blah, blah, blah. When real panic sets in, if there were to be a Lehman Brothers situation where some massive failure of something that has ramifications throughout the financial markets, or like in 2008, it was the banking, the mortgage crisis, something like that would still drive VIX to 90. Or, a worsening of a pandemic is what happened in 2020. But what can I predict those things are going to happen? No, I can't. So I don't really know how high it can go, but just buying a few calls, maybe 30% out of the money, just to have occasionally month by month is not a bad thing. By the way, if you're speculating on VIX, do not go out long term. VIX is a very short term speculative instrument. All right, I'm going to call it there. Thanks for attending. Please visit that website and pick up your free copies of the PDFs and take a look at some of our newsletters. So thank you very much for attending, and that will conclude the seminar.